All right. Well, at varying times today, it looked like we were going to be bullish, and then have a down day again with some oversold clusters on the market forecast chart, and then finally we finished the day near the highs of a relatively smaller range day, especially considering how bearish things have been. We'll talk about just how bullish it was and whether or not it was bullish enough to halt this decline that we've been on. And especially considering some signals that we've had, that bull tag on that weekly market forecast, is it enough, like Q1 of 2018, that we just bounce right off from here and get going to the upside? So I'm actually going to kind of show, how the difference between the first quarter of 2018, the fourth quarter of 2018, two different periods of time where we had bull tags in the weekly chart. With significant declines on those weeks, which makes you wonder a little bit about what we still have left to go this week. And then whether or not this is the ending or the beginning of a move, of this bearish move. So we'll talk about that in today's move, why I steer towards one versus the other. And again, I've been showing you multiple indicators as to what my expectations are, but I'll kind of reinforce that with some more today. We'll take a look at what drove the price action today. Very interesting pattern, not very surprising considering what we've seen for the past month. So we'll talk about that, and then our trade idea is a stock that's in the semiconductor sector that had been relatively volatile and has just gone through an earnings report on this particular trade idea, and we'll talk about how to take advantage of the lack of volatility that we've seen since. So let's go ahead and get started. Today is Wednesday, October the 4th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. As you can see there, we do that at 3:30 Eastern time. I take a look at all the old Market Outlook trades that we're still in to see whether we should stay in or get out of them. I know that gets requested a lot, but that's why I do that for all of our subscribers. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing, click the thumbs up icon. Sorry, it pulls up this tab. Hit that like button there. Again, the more you do that, it really helps us out, get our content out to all of our followers on those platforms with all the likes and retweets and the comments. So thank you to those who do that day in and day out. We almost got back up to 100, fell off a little bit there. But those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we rallied today, and we actually had a cluster early on in the morning, but then we ended up failing and not getting that cluster. The Russell 2000 actually had the cluster on for most of the day. It finished the day barely with a cluster, as your momentum line finished at 19.4. But the S&P had one too, and in fact, there's been multiple days here that while the intermediate line's been in the reversal zone, that we've had opportunities for clusters, only to have us rally off the lows or finish the day higher. Here's another time of that happening. So, of course, again, we talked about the near-term line getting back in the bearish territory. At least it's not in the reversal zone. So very good opportunity here, with a lower low and a higher low on the near-term line. This little bit of divergence to really kind of push up towards that moving average again. Again, whether it breaks through, it's another story, but at least pushing up towards it and getting up, kind of like, as you can see, getting back up to zero. We'll see if that ends up being the case this go around, and whether or not it actually gets a bear tag again. As we saw, it actually got above the moving average there. So the intermediate line's in the reversal zone. The market sentiment line's falling. It's not in bearish territory yet. As you'll see, it is in the Russell, but it's not in the bearish territory there. And you can see that we have an opportunity for the near-term line to come up into some pretty strong bullish levels. Same thing with momentum line, especially if we can get a intermediate confirmation signal, right? Or excuse me, we actually did get the momentum line down here with the oversold intermediate line. But especially if we can get a runaway gap, if we can start one of these days here this week with an opening gap that's significantly higher, so we can get a good overnight rally into the morning before the market even opens, get a good significant bullish move, and then follow up on that and really push higher, get that momentum line to spike up above 90. That would be our ideal scenario. If not, kind of just watch for the near-term line to see where it ultimately gets up to. Maybe up above 80. You can see just even to get above 90 wasn't necessarily the end-all, be-all for that particular run. So it's got to get up there and kind of stay up there for that intermediate line to get. I mean, in fact, that move got the intermediate line into bullish territory. Just was unable to hold, and it got quickly reversed down to extreme lows on the momentum line, and then the near-term line dropping down, and that ended. And so that was the problem that we had there. We haven't had a really good bullish near-term peak since, and it's we'll see if the next one actually is. Of course, I showed you the Russell 2000. It did get another cluster. It's the 8th cluster of this intermediate rally. We had to go back to 2018, where we had two streaks of 7 clusters during that particular correction. The market sentiment line is in the reversal zone. Again, that's a pretty significant move. It's one thing to get down in the reversal zone when you barely got out of it to begin with. It's another thing to get down the reversal zone after the market sentiment line was actually above the 80th percentile. So that's a pretty significant correction. It's more than just a pullback. Obviously we're below the 200-week moving average, and again, it's everything is down. We got a little bit of a hammer type pattern here today. We'll see if that sets at the very least a short term bullish low point here. Whether that turns into something more, right? Well, this has already made a run towards its moving average, and it failed. It actually got the near-term line also above 90th percentile and got a bear tag, but it failed the very next day, and we've been down ever since. So the last couple of attempts on the near-term line, near-term runs did not get quite to the moving average. This one got close, 1% away, and this one got less than 3% away. We're more than 5% away now, so we'll see where that next near-term rally takes us and how far up it actually ends up getting. All right, let's take a look now at some of these other indicators. Let's look at the weekly chart. As I mentioned, we're kind of closing on the 200-week moving average. It's maybe a smidgen below it, but nothing too significant. And the size of the candle, the average size of the candle, has actually dropped pretty low. So this week's candle, the body actually got a little bit smaller and is above that moving average. So again, another sign that things might be at least temporarily bullish for the next however many days. You can see we are so far at the lower close. We do have a lower low, so we're not set up for a transition candle yet next week. But that's something to keep an eye on. The Russell 2000, of course, has been a lot more bearish. Has a much stronger candle. See, it's not above its moving average, and it's actually lower. The PPO is negative and falling. We are clearly below the 200-week moving average on the Hakinyashi close. So a lot more significant there. You can see the Dow Jones Industrial Average as well. Clearly below it. It got pretty easily below it last week. We're clearly below it again. Again, very different scenario than last time, where it was a banking crisis that caused that. Pretty decent sized candles, also below the moving average. So you can kind of see outside of the Magnificent Seven, the rest of the market's really struggling, even with today's move, which was obviously not so bearish. You do have 3 red arrows across the board, except in the NASDAQ. Of course, the NASDAQ has been the most bullish, up over 1% today. 1.36%. The Russell finished the day positive, but just barely at the very end of the day. So you do have 2 green arrows on that. Obviously, you have to get 3 greens to turn this into green shading, and we're not obviously there yet. Looking at the 2-line versions for the S&P, we're right there at the 200-day moving average. Looking that we might bounce back up towards this 4,300 level area. As you saw the Qs, how bullish the Qs were. They're still below their 17-day moving average. The MACD, it's got the green arrow, so it's above its moving average, but you got to clear that 17-day which would also technically be this 23% Fibonacci retracement. So that would be kind of a signal that this trend, that this intermediate run is done, the pullback is done. That's not necessarily the case here for the Russell. Like, we are clearly, 100% retracement of this last intermediate rally or more. The MACD is below its moving average. We are way below all these moving averages, way below the 200-day even. And as I mentioned to you before, we're also, sorry, not the monthly, we are also below the weekly. You can see we are clearly below the 200-week moving average, clearly below that. In fact, the 8 and 17 week are crossing back below the 30. The stochastics is pretty bearish. The MACD is pretty bearish. And we are obviously a lot more bearish on the Russell than we are on the S&P 500, where we're just turning negative on the MACD, despite an extremely low stochastics, like I tweeted out here earlier today. The intraday chart's a really important chart, I think, to pay attention to. So in the past couple of weeks, Monday has set the high of the week. So last week it set the high of the week. The week before that it set the high of the week. And we retested it, came close to them both times. The week before that, we set the high of the week. And we actually broke through it on Thursday, only to have this runaway gap into expiration really reverse that breakout. So kind of a little bit of a fake out pattern there. So here's Monday, here's the high of the week. And on the bullish weeks, as you can see here, if I were to go back out really quick. So again, we've had, here, let's go here. So we've had a couple down weeks, but if you go out to some of these bullish weeks previously, so let's go back to some of those. And I'm going to have to go out a little bit more in time. So let's go out 90 days. So if you go out to some of those weeks, you can see when we were bullish, so those were when we were bearish, but when we were bullish, we got through Monday's high. Like, we gapped up, we set a high point, we got through the high and finished the week higher. We obviously didn't have in Tuesday, the Labor Day weekend, we actually set the high on Tuesday, and then we never tested that again. But the week before that on Monday, we set the high point early, and then obviously got through that high by the end of the week multiple times. Before, again, setting the Monday high point there and then never getting above it. So this is a really important, the Monday's high has been a really important level for us to break through and avoid a set of lower highs and lower lows on a weekly. Because if Monday's high is the high of the week, then there's a lower high point for the week. And we've already gotten down to a lower low, and the question is whether we'll end up closing below that low or not, or above it. And again, the likelihood of closing above it increases dramatically if we can get above Monday's high point and then stay there without a new, gap, runaway gap type pattern here. Especially if we can gap through that. That'd be outstanding. If we can gap up to, say, like 428 or 427, get above Monday's high with a gap, that would count as a significant gap here, because, again, from my definition, it's at least a one standard deviation would be about, for this past year, would be about 2/3%. So if we can gap up 2/3% tomorrow, or Wednesday, but or Thursday, excuse me, but sometime here soon, gap through there, get above whatever the 2/3% would be, would most likely get above Monday's high point, and then run away into last week's high point, then that would go a long way to, like, pretty much ending this bearish move and giving us really good indications. I don't believe that kind of move will happen, but that's the kind of move that we need to be watching for to say that we're done, right? I know a lot of people were talking about how, the market's done dropping today and how bearish it's been, and I don't think that that's the case. As you can see, we closed above yesterday's low point. We didn't close above yesterday's high point, and of course we're still holding Monday's high. Which, there's a pretty decent volume node at Monday's high point, so it's not going to be easy to break through that. But again, if you can see the gap here, that if we did get through that, then we have a really good chance to make a pretty decent move up towards filling in these gaps. Remember how I mentioned before that getting through that breakaway gap there, reversing that, would go a long way to ending this decline. That was back over here, and it never happened. But the same thing holds because there's still a big, tremendous gap there. We didn't get a new low today, so that's a good sign. So we set the clock with yesterday's new 4-week low point for 6 days. For this, we need to avoid a new low for the next five more days to get that red line below 70. That would set us up for, and you probably get that green line back to zero again, but that would set us up for the type of breakout move that would start a new intermediate rally to the upside. So those are kind of some short-term things to be watching for over the next little bit. Of course, again, today's move was pretty decent. It's a little bit below average, but a little bit above average on the volume. And you can see, again, those averages are rising. We're above the 1% mark. Usually intermediate declines end as you get closer to 1.5%. So you can see volume has been picking up. We're a little bit above average on the volume. And when volume picks up, it's not bullish. It's more bearish. When both these lines rally, it's more bearish. And obviously we've seen that. So we need to see, will that ATR rise? Will the volatility end up peaking at a really high level? Again, we got above 20 intraday. We didn't finish there. We actually finished below 20, and we still haven't got above 100% relative to the VIX 3M, which, remember, typical intermediate declines actually get above 105%. But considering that we've had such a hard time just to get above 100 throughout the entire correction of 2022, it's really been subdued how volatile things have been. And you can see the VVIX, after getting above 100, again failed to stay above 100. And just like that, we dropped below 20. Just like that, we dropped below 100 on the VVIX down to 95, despite the correlation still being very strongly positive. So volatility remains very subdued. We haven't had a washout move here that would suggest that, holy cow, we've really corrected and we need to break out. That's a pretty decent pattern there on volatility. We've seen this kind of pattern before at these peaks. So we'll see if that ends up playing out. Now we've had lots of ups and downs there, so we'll see how this ends up playing out, especially considering how high the momentum got here without a crisis, right? We had pretty strong momentum over there because there was a crisis, a banking crisis. Here we don't have a crisis. I mean, I guess you have a yields crisis, but we're not. There aren't any markets that are breaking right now or banks that are failing per se that are necessarily moving the market. So. I don't think necessarily this wave of volatility is done. In fact, I think we haven't really even started this wave of volatility for all the things I showed in Monday's video and last Friday's video. So, if you need to go back and watch those, you'll kind of get an idea of why I think we are still in correction mode. And as I mentioned to market scholars in classes yesterday, during a correction, there are plenty of up days. During corrections, there are plenty of up weeks. So just because we have an up day doesn't mean it's over, and today was a decent day, but it wasn't a up day that changes things. It was more of we were really, really bearish, and now things have reversed for at least a day. There's been a little bit of a counter trend, kind of a profit-taking counter trend move. Now whether or not that turns into a new trend in the other direction remains to be seen. But today's action doesn't suggest that it will yet. Tomorrow may be a different story if we get like I said, that good gap, or if we can get a strong breakdown, even more in volatility here. But if you look at today's move, you can see it basically was just a bounce back from oversold levels, except for commodities. Commodities had a big breakdown. Crude oil really dropped pretty sharply. We'll take a look at that here in a second. Everything else was just a rebound. If I go all the way back out to the beginning of September, where yields really started to make that's when yields started to run, starting on September the 1st, going forward. Let's get on a little bit of a different time frame so we can see the chart easier. You can see bonds were the biggest oversold. Real estate was really oversold. The Qs have been the safety trade, so they've been holding up really well, even better than gold has been. The dollar's been strongly bullish. That actually didn't change today. But commodities fell hard, but they have been falling already, really since way early in about the middle of September. There, it was just a kind of a free fall here today. But it was essentially just what was working turned down, and what wasn't working to a very large degree for a very small period. I mean, this is basically just a monthly period. What wasn't working over that month bounced, and that's really all it was today, just an oversold technical bounce that you're going to need a lot more, especially especially considering that we're barely above average on the range and below average on the range and barely above average in the volume. You're going to need you're going to need a bigger change in sentiment in order to change that around. So especially again, if we can gap up, get above Monday's high, gap up above it, follow through on that throughout the day when the volume kicks in, get a pretty decent range, well above the average, get some volume to kick in, then that would be a sign that sentiment has really dramatically changed. And obviously that didn't happen today. Looking at crude oil, you can see the big drop in that market. I mean, we dropped down to the 50-day moving average, still above the value area. We were well above the value area there. And the MACD and stochastics are clearly in bearish levels. Big volume, but not outsized volume, just a big outsized move. And really the last 4 days after hitting $95 pretty much on the dot, it has now dropped down to $85, just under 85. We have some old highs here in this area, so now the question is going to be whether we can actually hold that there. You do have some Fibonacci on this current intermediate run that we've been on. You're right at that 38% Fibonacci support level. So we're going to hold here. We're going to break through. There's the point of control still down there. So I wouldn't get too worked up. Typically, you get big moves like this when you're below the 50 and especially below the 200-day moving averages. The last time we had a move like this, and I tweeted this out, the last time we had a move like this up above these averages was kind of over here in this area. I think it was in May actually. This day right here was the last time we had a 5% drop when we were kind of above all these moving averages. Of course, we had a pretty decent trend by then. If you come over here to March 21, you can see again another day, a couple of days here where you had big moves to the downside, only just to barely get below the 50-day moving average. And that, was a big move. MACD was down, stochastics was down, but that kind of set the low, and then we rallied. And we even rallied off of this May level into 2022. So, getting a big 5% down day, and however big it's been over the last 4 days. In fact, if you look at the rate of change over the last 5 days, let's see how big that is, how big of a drop that actually is. Go to crude oil, and we'll go down to a 5-day rate of change. So it ended up being about a 9.89% drop. Again, that's not the biggest drop of the last, we had in March, we had a big drop going into expiration weekend there. It was down 13% in 5 days. Over here in December, and you can see we kind of set lows in both those instances. Now, granted, we were below moving averages there, but we kind of set some lows there. So, I mean, this move that we've had today is a big move, but it's hardly an extreme move. And when we have gotten those moves, as you can see, following along my cursor to the left, there's plenty of examples in 2021, 2022, and all of those instances kind of set the low point. And considering we're at the 50-day moving average, there's a pretty decent opportunity for us to set the low point again here, right there. Or, these start to base in at these old highs that are at that 38. Again, multiple touches here, as well as an old low point in this area as well. Lots of touches in this area right around $85. So we'll see if we end up holding that area or not. Of course, the other big news was the drop in yields. We were down 1.4% there on this index to 4.73%. So a pretty decent drop on yield, still way above the 8-day moving average. So it's more of a kind of an oversold. I mean, we have been going parabolic. The trend has definitely not changed. We haven't broken the 17. The MACD is still above its moving average. So we're hardly like reversing here per se. It's just a matter of, we just had a down day a few days ago, about a week ago, a couple of down days in a row, and we had some down days over here too. So this is hardly the first down day. We need to see a little bit more follow through if we're gonna, start to break that trend, which has had a pretty significant impact. Considering the dollar didn't really drop very much today either, that would suggest that, it's probably unlikely that we're getting a major move to the downside here. Like today's move, there wasn't any catalyst to reverse these trends. So when you get a situation like that, you just basically run out of, in this case, dollar bulls or treasury bears that have been so persistent lately. There's just a little bit of a consolidation, just like a little profit taking type move, short term counter trend move, that if we build on it, great. If we don't, which we haven't done on all the other times we've had it here on the dollar, then we just continue to follow the trend the very strong trend that we're currently on. As you can see from an Ichimoku cloud, it's a very mature bullish trend that doesn't end on just a little small down day like that. All right, let's take a look at the sector moves here. So let me pull up the sector comparison chart. And again, just looking at today. Well, let's go to that same September 1st time frame. So we can see, again, this is that time frame where treasuries really kind of took off here. And TLT was down, yields took off, and the dollar was so bullish. Well, of course, it put pressure on utilities and real estate. And you can see communication services, energy had been holding up well. They got hammered today. Communication services, healthcare holding up pretty well. So now if we just go look at today alone, you can see our big winners were our three big sectors: communication services, technology, discretionary. Real estate rebounded, considering how bearish it was. Energy had been so bullish, relatively speaking. It dropped 3% today in one day. That's a big drop for the energy sector. To kind of give you an idea, you can see utilities still struggling. If you take a look at that energy sector and this big decline it had, over 3% decline on XLE. I mean, you have to go back to June 20th. There's not very many of these, and that's a pretty significant move. When you look at, that had been one of the sector grids that hadn't been as bearish as others, but now, it's dark pink shading in a red line pretty easily now. Communication services doing okay. It's still kind of yellow moving average. The technology is light green shading. Again, barely above 20 though, rising. Communication service a little bit more bullish than others. But the fact that energy is dropping, everything else is still dark pink shading in a red line, doesn't suggest that we're going to be bullish yet. Again, good gap, good intraday move. Let's see what happens here in the next day or two. Push above Monday's high. Tomorrow or Thursday, different story. Then we'll start to take a look at just how bullish those days will be if they are to occur. I don't think they will. I'm in the camp that we're going to end up with a bigger weekly decline either this week or next week, because we are, just a reminder, again, depending upon where we finish the week, as of right now we have a bull tag, and we're flirting. Even if we don't get it by this week, we've had 2 weeks now, we're really flirting with it. So we are, and typically the weeks you get the bull tags or the week after, those are like pretty much all of the corrections have started with 3% declines or more. So, I mean, if this ends up being the low point and the pullback, great. We'll see if that ends up being the case. Which that's a possibility. I don't think that will be the case, but it's a possibility. But if this is the start of a correction, then either this week or next week, we're looking at like a 3% or more to like 3, 4, 5% or more decline. So like right now, we're not down very much at all this week. So if this is going to be the week of the bull tag and the 3% plus decline, then we're not going to hold Monday's high, and we're going to, we are going to get close below last week's low by 3%, and it's going to be a lot more bearish by the end of this week. I mean, that's actually a move below 4,200. Just barely, but below 4,200 if we're going to do that, get below that 3% mark. So, again, if we can break it and reverse it and get this significant change in sentiment, then we're going to feel a lot better about life. But if not, then we still haven't had, that kind of change where it's now where the market's like, now it's not a pullback. Now we need to really get entrenched here for what could be a much longer haul, a more of a correction. Again, if this ends up being a correction, these little moves that you're seeing here, if it ends up not being one of your typical intermediate decline, which we've already talked about for a lot of patterns, you would expect a correction. A 7% drop doesn't make a correction. They usually get down to the 15, 16, the mid-teens, kind of where the Russell 2000 has gotten down to. The Russell 2000 has gotten down to almost 14%. So if we are going to get something similar on the S&P, we're maybe halfway there. So that kind of goes to show just how much more bearish we can be if we are indeed in that mode. And if we're not, then this has been a nice deep pullback. And like kind of, so I saw a poll earlier this week that kind of suggested, or earlier today, excuse me, that suggested, what kind of move are we in? What would be a good analog for this move? And people put 1987. The options were like 1987, 2008, 1929, which are all bear markets, and this is hardly a bear market. So what I found interesting was, if you go back to 2018, we have two examples of what this could be. If this is a correction, right? You had a deep pullback bordering on correction that ultimately turned back up here. We had, you can see this was not the first 3% decline on the week of the bull tag. It was actually these two. So that ended up being the last 3% decline of the cycle on the week of the bull tag, and we rallied. Versus over here where we got the bull tag, we started it with a 3% or more decline to the downside, and you can see we ended up going further. So two bull tags, but two different kinds of bull tags. So a better poll for me would be, which one is this going to be? Early 2018, or because we can't really even say 2019, because 2019 you had Fed intervention that kind of avoided the correction there and really kind of bounced us up and got us going again. We had rate cuts, we had the Fed increasing their balance sheet again. I mean, that's not going to happen either. So it's more of, is this 2018 early Q1 or is it Q4? And again, I'm in the camp that it's more of Q4. And if that's the case, because we haven't had a 3% decline yet, or even a 2% drop in a single day, then that means that 3% decline is still coming to either end this move on like Q1 of 2018. Or start a new one like the last quarter. All right, now let's take a look at our trade idea of the day. So I want to take a look here at Micron is what we did in our Market Outlook Live video. We already put this trade on earlier today at 3:30 Eastern time when I do the Market Outlook Live. You can see it's had bull tags on a daily chart. And it's had bull tags that started some weak intermediate declines before. It had a few bull tags over here that actually ended up being a bounce back up to the upside. The intermediate line, is actually flirting with getting below the market sentiment, but nothing too strong. The near-term line got in the bullish territory, but not too bullish. Momentum line dropped to bearish territory, but not too bearish. So it's really kind of a sideways trend right now. There's not really a significant move in either direction. You'll notice here that you have a really small candle. This is a Hakinyashi candle. So it's obviously a much higher low point, but also a higher close. And a high and a low means we're kind of in transition mode here. So a really small range means there's not that much of a move. If you look at the 3 green arrow chart, get that Micron up here. We're sitting right at all these moving averages, so the MACD is pretty level at low negative levels, but at least it's rising. Stochastics is rising back towards out of bearish territory towards the chart's midpoint. So pretty sideways action considering we just had earnings. We're at the top of the value area, but not really breaking out one way or the other. The DMI, both the directional indexes, are sitting below 20, and the ADX is falling to really low levels, so that's telling you there's no trend. The RSI and the CCI, when you look at those charts, they're right at their midpoints. That's telling you really there's no trend going on. Looking at the Ichimoku cloud, we'll show you that we used to have a weak bearish trend after the earnings, but then that ended, so we have no trend going on here. Small bearish bias, but very, very small bearish bias. And then you got your Bollinger Band width, which is at 52-week lows pretty much, and you're right smack dab in the middle of it. So it's a very small bandwidth, easily inside the Keltner channels. You're in the middle of it. There's no momentum. It's slightly negative, but it's very slight compared to all these other negative momentum. So I like these setups for iron condor opportunities. So when you look at the trade tab, came to November expiration. I don't have to worry about earnings, right? So I sold the 20 delta there, sold the 20 delta here, going one strike away for protection. Position sizing up to a full position size because it's a relatively higher probability trade. You can see where my break evens are on the chart. Basically, my lower break even, I've got major support down there. And then my upper break even gives the opportunity for the stock to kind of break out to new highs and kind of catch up to where we were there in May before things turned south for the stock. So lots of room on either side, relatively decent probability. You get a pretty decent reward for the amount of risk that we're putting on for, like I said, a relatively higher probability trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.